Hey, good afternoon. I hope that our special edition of our weekly update last week around the Silicon Valley Bank turmoil was helpful. We're going to get right back into the normal kind of throes of things here this week, where we jump right back to the Fed with the Fed press conference on Wednesday, just yesterday. But a bit of change in tone kind of leaves some of the conversation open for interpretation. So we'll break that apart a little bit here today. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, data, trends that we're watching, and hopefully weed out a bit of the noise along the way. As you might imagine, a huge majority of our conversation today is going to be Fed-based. We are one day after the Fed decision and press conference, so that is where the focus will lie. That said, I do want to touch briefly on initial jobless claims numbers that came out today as well, with 191,000 was the number this morning. So again, another strong number. I believe this might be like 5 weeks in a row under 200,000. So it's showing a very strong labor market still with little signs of cracking. So that is a great segue, as you might imagine, into the Fed decision, because that is something they're weighing very heavily and watching very closely is, how hard they can press on these interest rates before they kind of break the labor market, so to speak, or I should say get it to where maybe a little bit more balanced position as far as job openings and employment. So Fed decision and press conference were yesterday, Wednesday, and that's obviously where we're going to spend most of our time. In short, I'll kind of summarize what has happened, and then I'll kind of share some of the takeaways I got from it, and then what we're kind of watching looking forward here. So in short, the Fed hiked 25 basis points. So for those who listen to our session here weekly, that a basis point is basically a measure of a percentage. So 25 basis points, or 0.25%, a quarter of a percent. Is this a sign that, so leading up to this, I had posted something on Tuesday actually on LinkedIn about my thoughts around the Fed coming up. And this is exactly what we had kind of expected, is that they would kind of continue down that path. Now, with the Silicon Valley Bank challenges, we were curious how that might kind of carry through to the Fed's decision, because quite honestly, the Fed has a big role in what is happening there. It's a lot of mismanagement by the bank, don't get me wrong, but this is the fastest hike in rates we have ever seen, ever. And so when that happens, it can create some challenges, especially for some of the assets that, in this example, Silicon Valley Bank had to sell to make their creditor or their depositors whole. So this has been a challenge. The Fed is certainly a big portion of what has come to be here. And so the question was, well, would this mean that the Fed wanted to pause and reflect on the policies and, the impacts to the economy? Clearly, with the 25 basis point hike, the answer is not yet. Now, I'll share more about the yet part here in a little bit, but that was really interesting, really important. Again, I still felt that they were going to raise rates because they've been talking about it nonstop. But heading into the meeting, actually, what I found interesting that Fed Chair Powell shared is he actually said that they did consider a pause in the days leading up to the meetings. He said a couple weeks ago they felt that they needed to raise rates more than they thought in the previous meeting. In other words, 50 basis points yesterday, and we saw the 25 basis points, but just a few weeks ago they were talking about 50 apparently. And then, in days leading up to this decision, they were even talking about a pause on the rate hike. Obviously, they decided to go right in the middle. They bumped rates up by 25 basis points, but it's really interesting to see this. And I'm hoping what this means is that the Fed really does feel comfortable in what they're seeing with the banks, because if they were concerned about that, generally what I would suggest is they would have paused, taken a breath, kind of reassessed what's going on. Now, the only caveat I have to that is that, unfortunately, it seems like maybe there's some ego at play with the Fed. So it's hard to say that is exactly what's going on. I hope that is the case. And this isn't a situation of looking weak or looking like they maybe messed up, like not taking the blame for messing up here. But nonetheless, hopefully the case is that they see very strong signals for the banks. We feel like this is more of a contained issue. Obviously, there still will be some ripple effects to some degree to some smaller banks, we feel, but much different than 2008 here, right? So, so that hopefully is a good sign for the broader economy. You know, it's kind of tough. Like, be careful what you wish for, because if they would have paused rates, we might have seen a big jump in the markets on the excitement of of keeping rates lower. But it probably would have meant that there were bigger challenges. So I think this is a good thing to see. And they came back time and time again about basically inflation too high and labor markets too tight. Inflation's too high, labor market's too tight. So this was, really interesting. I think they are still really focused on the inflation numbers. Remember that their two mandates are inflation and employment, but above all that is price stability and is economic stability. And so, this shows, I think that they feel pretty confident in what's going on there. What was interesting as we look ahead now is that the Fed did mention they no longer feel ongoing rate increases will be appropriate. So instead of a continued cadence of rate increases, they are moving to what I believe he said, basically that it would be additional hikes as appropriate, I believe is what he had shared in the conversation. So rather than ongoing, kind of meaning every time, now we're talking about really taking this case by case. And so, I think he left the door open for a pause in the next session is really what this comes down to. That will give them time to see what happens, make sure everything is stable, and also get some more inflation data between now and the next time. So we'll see what comes of that. But I think that's basically where this went, is the 25 basis point hike, a lot of conversation about setting expectations if they do pause next time, and then they'll take the next month or so to reassess here. What is interesting is that the median forecast for the rates by the end of the year is still 5.1%, I believe it was. So that's another hike suggested, but we'll see how the data kind of takes out here. And last thing that I wanted to mention is that somebody did specifically ask this question about money supply tools. So we've talked about this a few times in these weekly updates, but the money supply is really the issue with inflation. It's not necessarily interest rates. As weird as that might sound, certainly raising rates can slow the economy and therefore reduce the rate of inflation or growth in inflation, I should say. But it's not really the core issue. The core issue is really money supply, right? We increased the money supply so much during that COVID period that we were destined to deal with this inflation challenge that we've got today. And somebody asked about that specifically. They said, what about your other tools in your toolbox? Rather than dealing with the interest rates, what about dealing with the actual core of the problem, the money supply? And he basically dismissed the question. So I thought that was very interesting. The truth is money supply has decreased quite a bit over the last year or so. But nonetheless, even asked point blank about it, there is not much thought going into that. So clearly they feel rates are the best way to handle this issue, and that's what they're going to continue to focus on. So I hope that's helpful. There was a lot in this session. Again, the gist of it is 25 basis points. I think he set the tone for a potential pause in the next session, but also that, if inflation does continue and everything smooths out, that they could keep that door open too. We're going to skip our question of the week this week because this is really, the focus. But coming up next week, we have consumer confidence and housing data all kind of piled in, and we will continue to kind of keep you updated as well on, Fed movements and what's going on here. We did see a big drop at the end of the day yesterday after the Fed conversation, and today started up quite a bit, ended up, up slightly, closed pretty close to flat. So we'll continue to keep you posted as we see some of the, how the markets digest some of this moving forward here. Have a great upcoming weekend. We'll see you next Thursday at 3.